I'm joined by Indranil Pan. He's chief economist at Kotak Mahindra Bank and has published an article about India's interest rates in the Mint newspaper. Indranil, good morning. Thank you very much for joining us.
Good morning.
It seems as if today's rate decision is a foregone conclusion. Interest rate hikes?
Definitely, yes. We need interest rate tightening in India. But what has always been debated about is the timing of the interest rate movement and the quantum of the interest rate movement. Now, surprisingly, we had one move on 2nd of July, and even though there was a tempo building up for a 50 basis points hike cumulatively, I think what the RBI essentially wanted to do was split it up between a 25 basis point, which they gave on 2nd of July, and possibly a 25 basis points in today's policy.
Does this tell us then that the RBI strategy is to steadily increase interest rates by 25 basis point increments?
I think I would be looking at only a 25 and a very gradual policy. Now, as we say that the yesterday's statements were hawkish, at the end of the statement, they also did point out certain uncertainties in terms of the global growth. They also have said that the private consumption demand and investment demand needs to be more self-sustaining and a more durable trend, rather than sort of going low in one month and suddenly shooting up in another month. And to that extent, I think they have also very categorically indicated that the current calibrated approach looks to be the most appropriate. Now, I underline the word appropriate, and therefore I don't think that even with inflation running at 10.5 to 11%, there is much sort of reason to believe that RBI would be extremely aggressive in terms of interest rate increases.
I know you say that it was a bold move to permit state-run refiners to raise gasoline and diesel costs to cut the government's subsidy bill. A bold move, but a sensible move?
Definitely a sensible move and a long-awaited move maybe. Because what was essentially happening is that against these under-recoveries, India was providing for oil bonds which are below-the-line items in the budget, and we were never factoring these subsidies within the budget. Along with that, which will reduce the under-recoveries, they have also clearly said that any subsidies to oil companies would be on a cash basis. So they are trying to make the budget more transparent and therefore give more credibility to the budget-making exercise. In terms of the fuel price deregulation, I think whatever limited has happened is definitely a positive move for India in terms of the reforms path.
Indranil, thanks very much for joining us today. Indranil Pan, their chief economist at Kotak Mahindra Bank, speaking to us live from Mumbai.